Welcome to the long game. I'm Nathan Carter, and just so you know, this voice is AI generated, but the message is human, calm, and crafted to bring clarity. Today's episode is about something we all recognize, but few truly understand: brand. You see it every day, on your phone, on your clothes, on your coffee cup. Logos, colors, taglines, catchy ads. It's familiar. It's powerful. It feels like trust. But as investors, we have to ask a deeper question. What's behind the brand? What's underneath the polish? What's the actual machine that makes this brand into a business? Because let's be clear, you don't invest in a logo. You invest in a company. And every company is a machine, built of people, systems, products, decisions, and cash flows. Today, we're going to peel back the label. We'll look at how to separate the feeling of a brand from the function of a business. Because what makes a great investment is almost always hidden behind the logo. Let's start with an example you know. Starbucks. To most people, Starbucks means coffee, coziness, maybe a green mermaid logo. But what is Starbucks really? It's not just a coffee shop. It's a global logistics company. It's a system that sources beans from multiple continents, trains thousands of baristas, manages perishable inventory in every time zone, optimizes store layouts, negotiates leases, and turns a $4 drink into billions of dollars in annual revenue. The brand is the feeling. The business is the machine that delivers that feeling, consistently, at scale. And when you're an investor, that's what you're buying. You're not buying the latte. You're buying the supply chain, the margin control, the pricing power, the customer retention model. Let me say it simply. Great brands make people feel good. Great businesses make money while doing it. You need both. But as an investor, the second one matters more. Here's another example. Nike. To the world, Nike is about athletes, about inspiration, about just do it. But underneath the swoosh, there's a very sophisticated business. Nike doesn't manufacture most of its own products. It outsources. It focuses on design, brand, marketing, and distribution leverage. That's why its margins are so high. And Nike doesn't just sell shoes. It sells status, exclusivity, community. But again, what matters to us is the engine behind it. How fast does inventory move? What's the cost of acquiring a customer? How do sponsorships with athletes convert into actual sales? How resilient is the business when trends shift? Because trends do shift, and a brand that's beloved today can be forgotten tomorrow unless the machine adapts. Which brings us to a cautionary tale. BlackBerry. Do you remember when BlackBerry was everywhere? In the mid-2000s, it had the brand. People called it the Crackberry. Presidents used it. CEOs swore by it. But underneath that brand, the business was fragile. Slow to innovate, tied to hardware, unprepared for touchscreen disruption. So when Apple entered the market, BlackBerry couldn't pivot, and the brand collapsed with the machine. That's what happens when a business depends more on image than on infrastructure. So let me ask you, when you consider investing in a company, are you in love with the image, or are you studying the engine? Because behind every logo is a P&L statement. Behind every commercial is a cost structure. Behind every smiling customer is an operational burden someone has to carry, and carry well. Let's talk about Tesla. Tesla is one of the most emotionally charged brands in the world.
To fans, it's revolutionary, clean, futuristic. To skeptics, it's overhyped, risky, flawed. But as investors, we must go deeper. Tesla is not just a car company. It's a battery and energy platform. It's also a manufacturing experiment, streamlining vertical integration. It owns its own retail, its own service, its own supply line where possible. The brand draws the attention, but the business is what determines survival. Can it scale profitably? Can it compete in markets where incentives fade? Can it maintain margins as competitors catch up? These are not emotional questions. They are business questions, and they must be asked, especially when a brand is loud. Because the louder the brand, the easier it is to forget the math. Let's bring in Meta, formerly Facebook. Another huge brand, billions of users, global name. But what is the machine? Advertising, targeting, data, user behavior. When Apple changed its privacy rules, Meta's business was hit because the engine behind the brand, the ad targeting precision, was disrupted. The lesson? Even strong brands are vulnerable if the business engine is overexposed. Now, let's flip to a company with a quiet brand, but a strong machine. Procter & Gamble. You don't see P&G's logo on billboards, but you see their products in every home. Tide, Pampers, Gillette, Head & Shoulders. Each brand has been built, acquired, or scaled over time. And the business model? Global distribution, mass production, category dominance, operational efficiency. It's not flashy, but it prints money reliably. That's a case where the brand isn't loud, but the machine hums with precision. And sometimes those are the best investments, because they don't rely on the spotlight. They rely on systems. Let me bring this home with a metaphor. Imagine a stage. The brand is the performer, the one in costume, smiling, dazzling. But backstage, there's a crew, running lights, managing sound, moving props, timing cues. Without that crew, the show falls apart. Investors often get seduced by the star, but wise investors walk backstage and look at the setup. Ask, how complex is this business to run? How many things need to go right for profit to appear? Can this business scale? Can it survive pressure? Can it thrive without constant reinvention? These are backstage questions, and they often tell you more than the applause ever will. Now, how do you build the discipline to look past the logo? First, write down what you think the company does. Then, compare that to its financials. Do they match? If you think a company sells creativity, but 80% of revenue comes from advertising, you're looking at an ad business, not a creative one. Second, ask what would happen if the brand suddenly became unpopular. Could the business still function? Or does everything rely on image? Third, study the boring stuff. Margins, inventories, debt, supply chains, return on capital. Because in business, the boring stuff builds the durable stuff. Fourth, don't confuse consumer love with investor reward. A company can be beloved and still unprofitable. A company can be dull and still build immense wealth. You're not here to cheer. You're here to compound. Finally, think like a buyer, not a fan. Would you want to own this company, to run it, to be responsible for its employees, its strategy, its risks? That mindset takes you past the logo and into the reality. Let me close with this. Brands matter, but they're not magic. They are the surface of something deeper, the echo of something earned. And your job as a long-term investor is to see through the surface. Because wealth is not built on impressions. It's built on operations, on models, on repeatable systems that turn ideas into results. So the next time you feel drawn to a company, pause. Don't just ask, do I like this brand? Ask, do I understand this business? Because in the end, the market doesn't pay you for sentiment. It pays you for ownership. Ownership of engines, of systems, of value that lasts when the spotlight fades.